subsidiary ledger. We mentioned is a group of accounts with a common characteristics. Like example, all might be customer accounts or creditor accounts. So why we need subsidiary ledger? Because to put all the accounts in one ledger, to make it very big, and in some cases we have, let's say, 100 customers. So we need to open a ledger. We need to open a few pages for each one of those customers. It will be so difficult to find it out. These things normally we are talking about the manual things, because if you go to a software like SQL account or another software, you will notice that all of this is happen automatically. There is no any issue. So in addition to general ledger, containing accounts with additional to general ledger, a typical business has subsidiary ledgers containing accounts with customers, we call it sale ledger, and accounts of suppliers or credit, we call it purchase ledger. So customers' accounts, or what we call debtors, and creditors' accounts are called personal accounts, because each debtor or creditor is referred by the name of the company or the name of the person if he is a person, and each has its own account in the respective subsidiary ledger. General ledger thus will contain the remaining double entry accounts, example, the impersonal accounts. So like this, it will be easier for us to divide the account in different ledgers. Impersonal account, it's divided between real accounts and nominal accounts. Real accounts or permanent accounts with our that's like the accounts which are in the financial statement position. They are not closed at the end of each period. At the end of each financial period, the balances of those accounts will be carried forward. Let's say, so as we mentioned, in the subsidiary ledger, in the customer ledger or creditors ledger, we're going to put that these things, we call it by name, is personal accounts. Things we can highlight by name, like name of the customer, name of the supplier. The general ledger will include what we call it impersonal accounts. What are the impersonal accounts? First, we have real accounts, or what we call it permanent accounts, like the accounts of the land, the machines, and all these, all the accounts which are showing in the financial position statement. They are not closed, but those accounts normally by nature, they are not closed by end of the financial period, and the balance of it going to be carried forward, which is totally different than the accounts which we are showing in the comprehensive income statement or the income statement, because those are closed accounts already. So example including building, machinery, fixtures, inventory, and capital. The non-nominal accounts, or we call it temporary accounts, those which are closed at the end of the financial period, and normally those will show in the statement of profit and loss and other comprehensive income. Example like sales, like expenses, and so on. So what are the types of ledgers? We have subsidiary ledgers, we have general ledgers. In subsidiary ledgers, we put the personal account, like sales ledger, which contain the accounts receivables or debtors account. We have purchase ledger, which include the accounts payable or creditors accounts. We have the general ledger, which normally include the impersonal accounts, like the real permanent accounts, such as building and machinery, or the nominal or temporary accounts, which we call like the expenses and income. So this is the types of ledgers, two different groups of ledgers. If you, when we are learning in our classes, it's no problem. You don't need to open different ledgers, because you are not applying in reality. So like normally in the classes, we learn how to record in the journal, then post in the ledger, that's it. So it's not easy for you to do, because you are not following a real steps. So here we were talking about the ledgers. We have also what we call special journals. So again, if you remember, what are the main books we are keeping for our accounts? We have the journal, we have the ledger. Journal, where we post where we record our transactions, daily transactions, and the journal, the ledger, where we post those transactions, means we transfer each transaction to be reflected in the ledger. Special journal is used to record similar types of transactions, such as all sales of goods on credit or all cash receipts. Let's say if you have one journal for just the cash, instead of each time you sell cash, you will record in your journal in that journal. So you have a special journal just for cash. It will be very easy for you because maybe per day you sell 10, 20, 30 sales cash. So it will be difficult to write 30 transactions. And it will be time consuming and a lot of issues later when you want to follow up with the transactions. So it's easier to have a special journal for this type of transactions. What are the most common or most famous special journals? Most trading businesses use the following journals to record. They have sales journal for credit sales. They have return inwards journal for return inwards. They have purchases journal for credit purchases. They have return onwards journal for return outwards. They have cash book for receipts and payment of cash. They have general journal where other items which could not be recorded in the above journals. So most of the trading businesses, they will have this type of journals. What is the difference? Different that each transaction you post or you write or you record in its own specific journal. So to understand the types of journal, as we mentioned, we have special journals, we have general journal. General journal is we record the other transaction which is not recorded in the special journal. In the special journal, we have, as examples, we have sales journal for credit sales. We have return outwards journal for return outwards or purchases return. We have return inwards journal for returns inward or sales return. We have purchases journal for credit purchases. We have cash receipt and cash payment journals for any transaction happening in cash. So like this is the types of the journals. As I mentioned for today's class, that somehow there is no new ideas about recording or posting, but it's mostly about showing you that not always we have one journal or one ledger. In many cases, we're gonna to have special journals or special ledgers for specific transactions. So let's continue. Sales journal. What is a sales journal? Sales journal is used to record sales of goods on credit. So as we mentioned, we have many special journals. One of those special journals is the sales journal. The sales journal is used to record the sales on credit. That what are the things we sell on credit. We have cash sales or goods are entered in the cash book. So for sales, as example, we have two. Some is cash, so it go to cash book. Some is on credit. So we take it to sales journal. Credit sales of assets other than stocks of goods entered in the general journal. So normally the sales journal is only for selling the stock. It's selling our main product. If we sell something else or we offer another services, is normally we don't put in the sales journal. Credit sales of assets other than stocks of goods entered in general journal, as we mentioned. All entries in the sales journal are made from sales invoices. Each invoice is pre-numbered to ensure that all invoices are journalized. So this is the thing. Normally, when you want to key in the information from the sales journal, we have to use a number of the invoice to make sure that everything is gone in the record. As example, if you see like here, we have the sales journal. This is one of the examples. So here they are showing you what is a particular account debited. Because if you remember, we said in the sales journal, we put the sales on credit, okay? So normally when we want to sell on credit, what we put? We put debt, the customer, like Ahmad as example, credit, the stock or inventory or sales, it depends, okay? So for that reason here is written the particular account debited. It means which one is the other side, of the transaction, because those are all under sales. Here we have the invoice number. As we mentioned, it's better we put the invoice number to make sure that all invoices being recorded. And also this one is the invoices number is going to help us for auditing. Like when I see, like let's say here 1, 2, and here we have 5 as example. So you will ask here, what is that 3 and 4? Where are those invoices? So like this, it will be easier for you to track, okay? So maybe the 3 and 4 goes as for cash, so there is no credit. So it depends what is the system is applied in the company. And then we have like here, they are showing the folio, which is where is in the ledger. So like this account is where in the ledger, this account where in the ledger. So you will notice those accounts are in the sales ledger, okay? Then we have the amount of the transaction, or it depends on the what is the amount of each one of those transactions. So posting on sales ledger, if you want to post this transaction in the sales ledger, so you will notice here we have sales ledger, we have account for each one of them. Okay, we have in each account of the account for each one of this. And if you notice, we have like is for sales, and this is in what sales journal is written. And we have also the amount balances, like for the debit and the credit. You know, like we can either like put it as T account or put it like this columns, debit and the credit. It's up to you. You can show whatever you like. So based on the above example, the sales ledger will comprise the following debtors accounts. Okay. So this is, as I mentioned again, I'm not teaching anything new. It's all related to posting, recording in the journal, posting in the ledger. But here we have some different types of journals and ledgers for specific transactions. So posting to general ledger, it means we want to transfer the transaction from the ledger, from the journal to the ledger. Posting from the sales journal is made daily to the individual debtor accounts in the subsidiary ledger, namely the sales ledger, as we show now in the example. And monthly to the general ledger. The general ledger will contain the sales account and will record the total credit sales for the period. For the month of January, the sales account will be as follows. So if you notice here, this is the sales account in the general ledger is show what is the amount. So if you notice, it's just showing the total amount, is not showing the details, because the details it's already recorded in each one of the subsidiary accounts. So in this example, the sales account in the referred is referred to by its page number instead of the account number. GL9 means that the sales account can be found in the page 9 in the general ledger. The same applies to the sales ledger. For example, Ahmed's account can be found in the page 1 of the sales ledger, hence SL1C as above. Okay. So when we are mentioning about the folio, as I mentioned, is which page there. So when we see SG, it means sales ledger. When we see GL, it means general ledger. So like this, we can post the transaction, or we can record our transaction in the journal and post it in the ledger. So let's continue. When goods are, so here we finished talking about the sales ledger. Let's talk about the sales return, or written inwards ledger, or a written inwards journal. So first we talk about the sales journal, which is we put the credit sales. We talk about the sales ledger where we transfer those transactions. Now we will talk about the sales returns, or what we call it return inwards journal. When goods are returned by the customer to the business will issue what we call it a credit note. So when our customer gonna to return some of our sales to us, so we will issue what we call a credit note to indicate that the customer liability is reduced. Because let's say we issue for him invoice 10,000, then he return us product with 1,000. So we have to issue what we call it credit note to reduce his liability from 10,000 to 9,000. The procedures for posting the sales return journal are very similar to those for the purchase return journal. Daily posting are done in the sales ledger, while the total sales return will be posted at the end of the month to the sales return account in the general ledger. As example here, using the example of the sales journal above, assume that some of the customer return goods to the business. So the sales return journal will be like this. This is the title of the journal. This is the date. This is who are the customers, what they return. This is the credit note number, CN, it means a credit note. If you remember, when we are selling, we are putting difference as the invoice number to be able to follow. Here we have a credit note number because when we have a return from customer, we have to issue what we call it credit note. So here where we will find those transactions in the sales ledger in watch page, and then the amount. So like this, we can now record the sales return in the journal. Also, this one is going to go to the sales ledger. If you notice that here is the returns. If you notice that sales goes in their debit side, because this one, it's debit the customer, credit the sales. So for that reason, when we want to transfer it here, we will put it in the debit side of the customer. We put the sales. Then when we want to put the credit, which is, or sorry, the return inward, we need to decrease the customer. So what we put? We put debit, return, credit the customer. So when we are transferring to the account, you will put it at the credit side of the customer account, because this one, it's similar when we are putting the T account. So either you put T account, either you put table like this, debit and the credit, it's up to you. No any problem, okay? T account in many cases is easier for people to do and easier for them to figure out which one journal, which one later, okay? So the monthly posting, because that one, the previous one we were explaining, it will happen daily when any return happening. So then at the end of the month, we need to do a monthly posting to the general ledger, assuming that the sales return account is on page 10 of the general ledger. Then we will do this type of posting at the end of the month to transfer the return inwards to the general ledger. Similar, we have purchases journal. I'm not going to go through because again, it's same. When we have purchases, we can open purchase journal. We will put invoices number. Here you will notice that invoices are not similar like the sales invoices, because when we are having purchases, the invoice, we use the invoice number which is issued by the supplier himself. So we don't have the series of the invoices. But when we are selling, we will use a sales invoice number which is issued by us. So normally we will have a series of the sales, and having the invoices number is very important because in some cases the supplier or the customer is going to contact us to follow up a specific invoice or a specific payment about for specific invoice, or he is returning a specific product from a specific invoice, because sometimes we have rules and regulation for returning products. And this one, let's say like if you have the invoice in 10 June, so you give only 10 days for returning product. So the customer, when he is returning, he needs to mention this product is returned from which invoice, because maybe he's returning product for earlier invoice, which is already now you will not accept to get a return from it. Similar, we have purchases journal. I'm not going to go through because again, it's same. When we have purchases, we can open purchase journal. We will put invoices number. Here you will notice that invoices are not similar like the sales invoices, because when we are having purchases, the invoice, we use the invoice number which is issued by the supplier or the customer himself. So either you put T account, either you put table like this, debit the customer. So when we are transferring to the account, you will put it at the credit side of the customer account. So So this is the purchase return, also for the journal and for the ledger, also for the outwards. This one, the returns, when we are returning something to the supplier, we have also to issue credit note to reduce our liability to that supplier. Those I'm not gonna to go into it in details because, as I mentioned, all of them are same. The sales journal, the purchases journal, the credit return, the return inward and the return outwards, all of them are somehow similar. So let's move for what we call it control accounts. Today, as I mentioned, we don't have a new information to talk. We are talking about the journals and ledgers, and at the end, it's same what we have learned earlier, but it's more into talking about the special journals and special ledgers. So let's talk about the control accounts. The control accounts refer to the general ledger accounts whose balances represent the subsidiary ledger accounts' total balances. As example, accounts receivable and accounts payable. So accounts receivables is gonna to represent all the subsidiary accounts of customers. Accounts payable is gonna to represent all the subsidiary accounts of the suppliers. Are examples of control accounts for which the accounts balances are used to validate the accuracy of the related subsidiary accounts, because the balance of this is equal to the sum of all balances of the subsidiary accounts. Control accounts, what they do, they have to detect fraud and identify errors, as it provides the total figures of accounts receivables and accounts payable for the preparation of financial statements. So we have two types of the control accounts. We have two types of control accounts. We have sales ledger control account, we have purchase ledger control account, because as we mentioned, is related to the different type of the transactions. So the sales ledger control account is total account receivables account, which is all the customers. The purchase is all the suppliers. So this one, it summarizes the entries and balance of all customers. And this one, the balance of all the suppliers. Here is explaining to you the control accounts. We have accounts receivables, we have accounts payables, and this one it include like the customer 1, customer 2, and customer 3. So it will be like this. So this is, it will be at the general ledger level. This one will be in the subsidiary ledgers. This is example. You can go through the example because at the end it's same transaction, but here, and you know how to record the transaction, but here is gonna just to show it how to show in the subsidiary ledger and in the general ledger. So all of this, it's available in the slides. You can see it. I already shared with the slides with you. So when we are having a control accounts, we have what we call reconciliation, which is to check whether this account or this journal, it has any issue, any mismatching. So reconciliation of control account is made when a difference exists between the balance on the control account and the total balances in the ledger it controls. As example, we have the subsidiaries account for suppliers, and we have subsidiaries account for suppliers, and we have the purchase control account. So when we see there is difference between this one and this one, we can try to follow up and see what is the issue. So it's necessary to identify the causes in order to do that needed correction. Some important tips for this one. If an error is found in the books of prime entry, the control account is incorrect, but it will not affect the sales or purchases ledger. So a record will be made in the adjusted control account. Also, another things, if an error is found in the debtors and creditors individual accounts, a record will be made in the reconciliation statement. If the error is found in the total, the control accounts are affected as the error includes the information in total form. So this, just read it, see what the difference, what is the issue, how we can do reconciliation for control account for your general knowledge. Cash receipt journal, it's similar as the previous journals we talk when we talk about the customers or suppliers journals, and is just for cash transactions. Cash payment journal is also just for the things which we are paying. So all of this is just similar than what we have learned earlier about writing in the journal and in the ledger. Same, it's talking about the cash book and how it can be 2 columns, how it can be 1 column. All of this is just repeating to whatever you have learned before, but as a view of different journals and ledgers. At the end, what is required from you, you have to know this information. But in the exam, when I'm asking you, like, please write in the journal, write in the ledger, like post in the ledger, just write the transaction in that normal journal and then post the transaction in the ledger. That's it. Just open the T account and post the transactions. So this is all about recording. You can read all of those slides to get information about these things. So as you know, most of today's class is about just repeating similar things which we have learned earlier, which we have like see earlier about transaction, about how we can record the transaction in the journal, how we can transfer it to the ledger, and all of this. Today's class is just kind of like general knowledge that yes, maybe in many cases we don't have only one journal, we have many journals, we have subsidiary journals. We don't have one ledger, we have subsidiary ledgers. At the end, recording the transaction is same. Deciding which one debt, which one credit is also same. So all of this, it's same.